Investors, you know how much I love the triple Qs, and they are a surefire way to grow wealth over time. But what about this spanking brand new ETF QQQY, put out by Defiance ETFs, that's bolstering a 68% dividend yield? Well, that sure is better than the triple Q's 0.61% dividend yield. That means if I put my full $155,000 portfolio into triple QY, I could be making $105,000 a year, a six-figure income, and I can quit my day job and retire early. If only life was so easy. Let's dive in and see if I could really do this. The NASDAQ 100 Enhanced Option Income ETF was established on September 13th, 2023. I normally don't make videos on ETFs that are brand new, but I got so many requests about this ETF, I easily sold out of my morals. This fund, by the way, is managed by the same fund manager for YieldMax's ETFs, Jay Pestrichelli, who is definitely a sharp guy. I mean, he has rich in his name. He's a really sharp dude in the interviews I've seen with him. The way this fund is paying out such high dividends each month is through its use of daily options to realize rapid time decay by selling in-the-money puts with 0 days till expiration. Generally, most income ETFs do weekly or monthly trading of options. This is every single day the market is open, they're going to be doing options trading. This is a very risky strategy that's often referred to as day trading options that's going to rely on rapid time decay and short-term price movements. Unlike most of the income ETFs we've usually talked about, triple QY is not doing covered calls. It has a bullish sentiment on the market. This means we think the underlying equity will go up in value versus with covered calls, we would benefit if the stock trades sideways or move down. With 0-day expirations, the fund will sell put options that are either priced at the money or up 5% in the money, aka higher than the current market price. They're going to be selling the put before market close the day before. Let's go over one more time what a put is. This means we're entering an options contract to potentially buy an underlying asset at a specified price, aka the strike price, if the option holder chooses to sell it to you before or on the contract's expiration date if it's below or in the money at that strike price. Now, for us taking on that potential obligation, we receive a premium payment from the option buyer. Selling puts is a great way to make money to buy a company that you otherwise wouldn't mind holding. For example, let's say I really like Coca-Cola, and I want to buy the stock right now, which is at $53 a share. I really like KO, but I really only want to invest in it at $52 a share. So I can sell a put option a week from now at $52, and as a reward, let's say I get $12 in premiums. What's happening is I'm entering into an agreement to buy Coca-Cola. If the price falls below $52 by the end of the week, I most likely will be obligated now to buy 100 shares at $52 a share. So it's a win-win for me because I wanted to buy KO anyway, and I got paid a premium to do so. You get paid to buy a stock. If it didn't fall below $52, let's say it ended the week at $52.10, well, that's also great because now I get to keep the premium no matter what. I always get to keep that, and I don't have to buy the shares because my obligation is extinguished. Heck, I can even do a trade at the very next week at a $51 strike price and make even more money with premiums. But with the 0 days till expiration strategy that QQQY is doing, this is on steroids because they are selling the put already in the money, expiring the very next day. Imagine in my Coca-Cola example, if rather than selling at $52 a week from now, I say I'll actually take your shares that are currently worth $53 at $53.50 by the end of the day, meaning I'm paying more than they're currently worth. Of course, I could still benefit if Coca-Cola price does very well, hence why this is more for people who are bullish on the underlying equity, but that's never guaranteed. For taking on this extra risk though, you do get a bunch more in premiums, hence why this fund is able to pay out so much in dividends. Per the fund's prospectus, they're aiming to sell in-the-money put options to get a daily income of 25 basis points, which is an absolutely insane return every single day. Also, they settle transactions in cash. They don't actually own shares of the index, and they'll do that within 24 hours of the trade. It's going to settle in cash. In addition to options trading, the fund will also hold on to short-term US Treasury securities for collateral purposes and to generate income. You'll actually see this in the fund's holdings. There's two main reasons to invest in this fund: to generate monthly income not dependent on the price appreciation of the index, and participate in a portion of the potential gains experienced by increases in the value of the index. However, the prospectus clearly states that buying QQQY is not the same as investing in the QQQs. It does not directly invest in the index. Now, like I mentioned, there is a huge risk in doing this strategy. This is the part where some will just put their hands over their ears because they like to think everything is risk-free and easy money. But the smart investor will listen very carefully to this part. For one, the fund is subject to all potential losses. So if the stock price goes down a significant amount in a short period of time, which the market is known to do that can really hurt this fund because the value that it goes down won't be offset by the income received in premiums. There could also be a day where the world shuts down due to a global pandemic and the stock market goes down 13%. Days like that are really going to hurt funds like this. This is because to settle the significant drop in cash, that's going to deplete the fund's NAV, the net asset value, which means less money to do put options and ultimately less in premiums and cash that's going into your pockets. And yes, while these events are rare, they do and will happen. Just look throughout history. And no, you cannot predict a black swan event. I love these comments I've been getting lately where people are like, yeah, I'm gonna hold the fund for exactly 2 years, I'm gonna recoup my initial investment, and then I'll get out. Yeah, because making money in the stock market is that easy. You're the only one who's ever uncovered this super sophisticated trading strategy. You deserve a Nobel Prize in economics for this amazing discovery. Let's also not forget when distributions are paid, the ETF will also go down by the amount of the distribution. QQQY has only paid out one dividend so far, so the dividends will be paid out on a monthly basis going forward. This past month, it was for $1.10, and if we look at the stock chart, we see a nice drop on their ex-dividend date for roughly the same amount as their distribution. Just remember, if held in a non-retirement account, Uncle Sam will get a greedy cut of your profits, and Defiance charges a 99 basis points expense ratio. That's roughly $99 for every $10,000 invested every year for managing this fund. Remember, that gets paid whether you make money or whether the fund loses money in a given year. Now, it's nice that someone else is doing this complicated investing strategy for us, but ultimately, when there's so many other low-cost, passively managed ETFs like VU or SPY that deliver time and tested results, it really makes me wonder about these income ETFs. These are investments I'd really have a hard time sleeping well at night with, as zero-day options can emotionally be taxing and stressful. The probability of success depends on short-term price movements, which means this isn't really investing, it's more like gambling, and I don't think most investors will have the right exit strategy. That's not to say I don't think these don't or ever will have a place in a person's portfolio, especially those who just want passive income and don't care about capital appreciation. These could potentially do well in stable or bullish markets or periods with high implied volatility, but timing that just right is going to be so hard. The average investor will make more money just investing in the S&P 500 index, but I know you won't do that because YOLO. Instead, you want those individual stock picks. Well, luckily, I share those with my Patreons every single week who get full access to my $155,000 portfolio, and I'm still beating the market this year. Check out how much I made in dividends this past month right here. My videos are always found in podcast form under the Collect Cash podcast name. Leave any questions or comments you have about income ETFs or QQQY in the comments below, and I'll catch you on the next one.